It is time now for Futures in Focus. Oil is rebounding today after posting its worst week since July. The dollar index, well, it's doing a bit of a U-turn. Joining us from the CME is Paul Nolte, portfolio manager at Kingsview Asset Management. Let's start with the dollar index, with trade on everyone's mind. Paul, we had the dollar index strengthen and suddenly do a bit of a U-turn and weaken again. What's going on there?
Yeah, it's one of those, when you take a look at the longer term trend, we've seen kind of a 1.5 steps forward, 1 step back. So the trend has been generally a little bit higher. We've been generally sideways for the last month and a half with that upward bias. And I think really when you're taking a look at it, it's a little bit of a break from last week's strength in the dollar, and we're not reading much more into it at this point. But when you look at the U.S. economy, it's performing well, and the Fed is going to be raising interest rates, which is providing a little additional support to the dollar over the next, we think, over the next 4 to 6 weeks or so.
And then, Paul, we must turn to oil, because it seems like oil is going higher based on, things that have been true over the last several weeks, including shortages from Iraq. So why is oil going higher today?
It's another one that's gone a little bit counter trend. Oil has been performing much better than all the other commodities. We're seeing a little bit of news out of OPEC that they may continue their sanctions or their cuts. We're seeing a little bit higher supply, though, as well. Inventories are up. And oil has been, over the last couple of weeks at least, moving against the dollar. So as the dollar's come off, oil has come up. It's been a little bit counterintuitive, but that's really what we're seeing in that market right now.
And then we added a few basis points to the 10-year yield here in the U.S. Last week. Do you anticipate that that might continue as well? Or what is your outlook, your best trade, let's say, Treasuries-wise?
The Treasury market is really the tale of two parts, the short end and the long end of the curve. We're still seeing a flattening of that yield curve. The long end is responding to lower interest or lower inflation rates. The short end responding to the Fed. The Fed will move 2 more times, we think, this year, and we're going to see a very, very flat yield curve by the end of the year. Inflation's not an issue, so we don't see much movement really in the 10 or 30-year bonds at this point. Those will be pretty stable for the next few weeks.